Equity is ownership. Equity that I'm talking here right now is equity share, that is ownership of companies. You know why I think equity is a beautiful concept? That is because when we buy the shares of the company, we become the part owners of that company. We don't have to worry about the working of it, but eventually we also get a growth in the long run. So tell me, do you think India has a growth scope? Obviously yes. But have you ever thought why? So let me tell you. First of all, the consumption ratio in our country is more. As India is a youth-driven country and the population of young people keeps on increasing day by day. This huge young population has dreams, ambitions and goals for themselves, for which they will want to work in companies. Eventually, these companies will grow. For example, companies like Birla, Tata, Godrej and many more, when they grow, they lead to the India growth story. So by buying equity shares, you're not only owning a part of the company, but also investing in the India growth story. Now how to start investing? For basics, in the online method, you will have to have a Demat account. For the same, you can inquire with your own bank. Next, you have to decide on the companies you want to invest in. See, if you want to self-handedly keep a track of your own investments, then you will have to remove some time and do some research before investing. You can do the research in two ways: technical and fundamental. In technical analysis, the past performance is tracked down with the help of charts and patterns. This analysis is usually done by the professionals who are also known as technical analysts. Fundamental analysis includes understanding the industry or the sector of the company. For example, if it is from pharmaceutical industry, IT or finance, etc. Also, the management, the assets, the liabilities, the revenues, the future growth, return on equity, profit margin. In short, it focuses on the financial statements of the company you are trying to evaluate. So, I want to take a classic example of a share called as Royal Enfield. I'm sure you would have heard about the bike Royal Enfield. So, basically, I'm going to give you a background of that company. So, in the year 2000, when Mr. Siddharth Lal became the CEO of the HR Group, the share price of Royal Enfield was 17.50. At that time, if you would have bought a bullet for yourself from Royal Enfield for approximately 55,000, today you would have a rugged bike for yourself. But if you would have invested that same 55,000 in the share of Royal Enfield, the value as on today would have been 4.5 crore. So price of the share went from rupees 17.50 per share to as on date 25,530. So what made a share grow so much? So till the year 2004, HR Group had a diverse spread of products like trucks, tractors, footwears, garments, motorcycle components and many more. But none of this was a market leader. In this year, Mr. Siddharth Lal took a courageous and an optimistic decision to concentrate only on the motorcycle, that is Royal Enfield, and trucks. This decision of his increased the sales of Royal Enfield, upping the value of the share. So in this market, you have to be on a lookout for companies who you think have a growth scope. So to understand the growth scope, we can look at the product current trends or demand in the market. Also the future trends and demands in the market. Second, we can consider the cost effectiveness of that same product compared to the competitor, and also the target audience or the target customer of that customer group of that product, and many more such factors which can account for you to find what is the growth scope of the company via this product. So ultimately from this example we can also see that the growth scope or growth time Royal Enfield took was from the year 2004 and still it is going on. So you have to be a patient investor with your investments. So in this segment, I spoke about the sweet side of equity. Look out for my next segment where I will touch base upon the risk factor in equity.